Hello, this is Govt and today's topic of discussion is debt market in India. In the previous session, we learnt about money market in India. In this session, we are going to discuss debt market in India. Let us first understand the meaning of debt market. The debt market is a market where fixed income securities of various types and features are issued and traded. Debt markets are therefore markets for fixed income securities issued by central and state governments, municipal corporations, government bodies and commercial entities like financial institutions, banks, public sector units, public limited companies and structured finance instruments. Here in the meaning we had gone through the two important words, they are securities and fixed income securities. First, let us understand both the terms in detail. Securities are financial instruments that represent a creditor's relationship with a corporation or government. Generally, they represent agreements to receive a certain amount depending on the terms contained within the agreement. While fixed income securities are investments where the cash flows are according to a predetermined amount of interest paid on a fixed schedule. Another topic that we need to know is the structure of debt market in India. And let us understand the structure of it. In order to understand the structure of the debt market, we will look at it through a framework based on its main participants. These participants are regulators. The debt regulators are RBI, SEBI, Department of Company Affairs, that is DCA. Issuers are entities which issue these instruments and are primarily corporate or the government. Another is instruments. The instruments are the certificates issued in tradable form. Investors. Investors are entities which invest in these instruments or trade in these instruments. Investors in debt market are wholesale debt market, banks, financial institutions, RBI, insurance companies, mutual funds, corporates and FIIs, retail debt market, individuals, pension funds, private trust, non-banking financial companies, NBFCs and other legal entities. After discussing the structure of debt market, now let us understand various debt market instruments in detail. The instruments traded can be classified into the segments based on the characteristic to the identity of the issuer of these securities. Main categories of securities for government securities, which are issued either by central government or state government. For central government, zero coupon bonds, coupon bearing bonds, treasury bills and strips. For state government, coupon bearing bonds are the types of debt instruments. While for public sector bonds, government agencies or statutory bodies, the debt instruments are government guaranteed bonds and debentures. For public sector units, PSU bonds, debentures and commercial papers are the debt instruments. While for private sector bonds, corporate, banks and financial institutions issue the bonds. For corporate, debentures, bonds, commercial paper, floating rate bonds, zero coupon bonds, intercorporate deposits are the debt instruments. For banks, certificate of deposits, debentures and bonds are debt instruments, while for financial institutions, certificate of deposits and bonds are the types of debt instruments. There are three sectors in which debt instrument can be issued. They are government securities, public sector bonds and private sector bonds. So let us understand each one of them in detail. First is government securities. A government security is a tradable instrument issued by the central government or the state governments. It acknowledges the government's debt obligation. Such securities are short term, usually called treasury bills with original maturities of less than 1 year, or long term, usually called government bonds or dated securities with original maturity of 1 year or more. RBI issues government securities on behalf of the Government of India. Government securities offer fixed interest rates where interest is payable semi-annually. For short term, there are T-bills, that is treasury bills, which are issued by RBI for 91 days, 184 days and 364 days. They are of two types, central government securities and state government securities. Next question is, who are the main investors of government securities in India? Traditionally, the banks have been the largest category of investors in government securities, accounting for more than 60% of the transaction in the wholesale debt market. The banks are a prime and captive investor base for government securities, as they are normally required to maintain 25% of their net time and demand liabilities, that is, statutory liquidity ratios SLR, but it has been observed that the banks normally invest 10% to 15% more than the normal requirement in government securities because of the requirements such as risk-free nature of the government securities and greater returns in government securities as compared to other investments of comparable nature. Now the question comes, who are the main issuers of the government securities? In India, the central government issues T-bills and bonds or dated securities, while the state governments issue only bonds or dated securities, which are called State Development Loans or SDLs. Government securities carry practically no risk of default and hence are called risk-free gilt-edged instruments. The Government of India also issues saving instruments such as saving bonds, national saving certificates, NSCs, and special securities like oil bonds, Food Corporation of India bonds, fertilizer bonds, power bonds, and so on. Move on to the next topic, that is trading in government securities. There is an active secondary market in government securities. The securities can be bought and sold in the secondary market. The secondary market allows debt instruments to be sold by an existing investor prior to maturity at the prevailing market yield. An active secondary market is an important ingredient in the successful promotion of primary issues. They are traded on. First is over-the-counter or telephone market. In this market, a participant who wants to buy or sell a government security may contact a bank, a primary dealer, or a financial institution, either directly or through a broker registered with SEBI, and negotiate for a certain amount of a particular security at a certain price. Such negotiations are usually done over the telephone, and a deal may be struck if both the parties agree on the amount and rate. In the case of a buyer, such as an urban cooperative bank wishing to buy a security, the bank's dealer, who is authorized by the bank to undertake transactions in government securities, may get in touch with other market participants over the telephone and obtain the codes. All trades undertaken in the over-the-counter, that is OTC market, are reported on the secondary market module of the negotiated dealing system NDS. Second one is negotiated dealing system. The negotiated dealing system NDS for electronic dealing and reporting of transaction in government securities was introduced in February 2002. It allows the members to electronically submit bids or applications for the primary issuance of government securities when auctions are conducted. The negotiated dealing system NDS also provides an interface to the Securities Settlement System SSS. Third one is negotiated dealing system order matching NDS-OM. In August 2005, the RBI introduced an anonymous screen-based order matching module on the NDS called the Negotiated Dealing System Order Matching NDS-OM. This is an order-driven electronic system where the participants can trade anonymously by placing the orders on the system or accepting the orders already placed by other participants. The NDS-OM is operated by the Clearing Corporation of India Limited CCIL on behalf of the RBI. Direct access to the NDS-OM system is currently available only to select financial institutions such as commercial banks, primary dealers, insurance companies and mutual funds. Other participants can access the system through their custodians, that is, those with whom they maintain gilt accounts. Next question arises that what to do when there is oversubscription government securities in India. Retention shall be done for the oversubscription limit. In addition, now I am going to state different regulations to the oversubscription of government securities. First, in general, issuers shall be allowed to retain the oversubscription money up to the maximum of 100% of the base issue size or any lower limit as specified in the offer document. However, for the issuers filling a shelf prospectus, they can retain oversubscription up to the rated size as specified in their shelf prospectus. Second is the issuer of tax-free bonds who have not filed shelf prospectus, the limit for retaining the oversubscription shall be the amount which they are authorized by CBDT to raise in a year or any lower limit, subject to the same being specified in the offer document. Third is currently in respect of public issue of NCDs, SEBI regulations does not specify any maximum cap on the retention of oversubscription. Now, another topic to discuss is public sector bonds. They are those bonds which are issued by public sector units in India. They are divided into two parts: government agencies or statutory bodies and public sector units. Moving ahead with the last segment of today's session, that is private sector bonds. Private sector bonds or corporate bonds, CBs, are debt instruments which are issued by private companies to fulfill their financing needs. Now, let us understand further subtypes of bonds that are covered under these three sectors. First is government guaranteed bonds. These are debt securities that offers a secondary guarantee that interest and principal payment may be made by a third party should the issuer default due to the reasons such as insolvency or bankruptcy. A guaranteed bond can be municipal or corporate, backed by a bond issuer, a fund or group entity or a government authority. Second is a debenture. A debenture is a type of debt instrument that is not secured by physical assets or collateral. Debentures are backed only by the general creditworthiness and reputation of the issuer. Both corporations and governments frequently issue this type of bonds to secure capital. Third is corporate bonds are private sector debt instruments. These bonds come from PSUs, that is public sector units, and private corporations and are offered by an extensive range of term up to 15 years. There are also some perpetual bonds. As compared to government securities, corporate bonds carry high risk which depend upon the corporations, the industry where the corporation is currently operating, the current market conditions and the rating of the corporation. Fourth one is certificate of deposit, that is CDs. These are the short-term instruments issued by commercial banks and specialized financial institutions. These bonds are negotiable money market instruments. CDs usually offer higher returns than bank term deposits, are issued in electronic form and used as the promissory notes. Banks offer CDs which have maturity between 7 days to 1 year. CDs from financial institutions have maturity between 1 to 3 years. Fifth one is commercial papers, that is CPs. These are the popular instruments for financing working capital requirements of companies. They are short-term securities ranging from 7 to 365 days. CPs are issued by corporate entities at a discount to face value. They are issued in the form of promissory notes. Some bonds called zero coupon bonds do not pay out any interest prior to maturity. These bonds are sold at a discount because the value from the bond occurs at maturity, when the principal is returned to the bondholder along with the interest. One type of zero coupon bond is strip. A strip bond is bond where both the principal and regular coupon payments which have been removed are sold separately, also known as zero coupon bond. But how is the price determined in the debt markets? The price of a bond in the markets is determined by the forces of demand and supply, as in the case of any market. The price of the bond in the marketplace also depends on number of other factors and will fluctuate according to the changes in economic conditions, general money market conditions including the state of money supply in the economy, interest rates prevalent in the market, and the rates of new issues and credit quality of the issuer. There is, however, a theoretical underpinning to the determination of the price of the bond in the market based on the measure of the yield of the security. Each debt instrument has three features: maturity, coupon and principal. Maturity of the bond refers to the date on which the bond matures, which is the date on which the borrower has agreed to repay the principal. Term to maturity refers to number of years remaining for the bond to mature. The term to maturity changes every day from date of issue of the bond until its maturity. The term to maturity of a bond can be calculated on any date as the distance between such a date and the date of maturity. It is also called as the term or the tenure of the bond. While coupon refers to the periodic interest payments that are paid by the borrower, who is also the issuer of the bond, to the lender, the subscriber of the bond. Coupon rate is the rate at which interest is paid and is usually represented as a percentage of the par value of a bond. Principal is the amount that has been borrowed and is also called the par value or the face value of the bond. The coupon is the product of principal and the coupon rate. The name of the bond itself conveys key features of the bond. For example, a GSCG 2008 11.40% bond refers to central government bond maturing in the year 2008 and paying a coupon of 11.40%. Since central government bonds have a face value of ₹100 and normally pay coupons semi-annually, this bond will pay ₹5.70 as 6 monthly coupon until maturity. The key role of the debt markets in the Indian economy stems from certain reasons such as efficient mobilization and allocation of resources in the economy, financing the development activities of the government, transmitting signals for implementation of the monetary policy, facilitating liquidity management in tune with the overall short-term and long-term objectives. Since the government securities are issued to meet the short-term and long-term financial needs of the government, they are not only used as instruments for raising debt, but have emerged as key instruments for internal debt management, monetary management, and short-term liquidity management. But what are the benefits of an efficient debt market or to the financial system and the economy? First is a reduction in the borrowing cost of the government and enable mobilization of resources at a reasonable cost. Second, it provides greater funding avenues to public sector and private sector projects and reduce the pressure on institutional financing. Third, it enhanced mobilization of resources by unlocking illiquid retail investments like gold. Fourth, development of heterogeneity of market participants, and also it assists in the development of a reliable yield curve. Fiscal Responsibility Act, the Fiscal Responsibility and Budget Management Act 2003 FRBMA is an act of the Parliament of India to institutionalize financial discipline, reduce India's fiscal deficit, improve macroeconomic management and the overall management of the public funds by moving towards a balanced budget. The main purpose was to eliminate revenue deficit of the country by building revenue surplus thereafter and bring down the fiscal deficit to a manageable growth of GDP. The main objectives of the act were to introduce transparent fiscal management system in the country, to introduce a more equitable and manageable distribution of the country's debts over the years, and to aim for fiscal stability for India in the long run. Additionally, the Act was expected to give necessary flexibility to Reserve Bank of India for managing inflation in India. Fiscal management principles are: the central government by rules made by it was to specify certain rules. These are a plan to eliminate revenue deficit by 31st March 2008 by setting annual targets for reduction starting from day of commencement of the Act. Second is reduction of annual fiscal deficit of the country. Third, annual targets for assuming contingent liabilities in the form of guarantees and the total liabilities as a percentage of the GDP. Now let's discuss content of the Act. Since the Act was primarily for the management of government's behavior, it is provided for certain documents to be tabled in Parliament annually with regard to the country's fiscal policy. This includes these along with the annual financial statement and demands for grants. The Act further required the government to develop measures to promote fiscal transparency and reduce secrecy in the preparation of the government financial documents, including the union budget. Before concluding, let's discuss switch deals. It's option which can be practiced by the buyer or seller to switch the deal into another market. Debt instruments can be converted into any other financial instruments. Some debt instruments possesses these types of characteristics of switching the deal into other financial market. Now let's summarize today's lecture on debt market. The debt market is the market where fixed income securities of various types and features are issued and traded. They are of short term. Its structure include government securities, public sector units and private sector units. These all sector units issue various types of debt instruments to fulfill the financial need of the market. There are various bonds like corporate bonds, government guaranteed bonds, debentures, PSU bonds, CPs, CDs and many more. They are priced according to the demand and supply forces acting in the market. The feature of debt instruments is maturity, coupon and principal amount. Debt market is much beneficial to the government because it provides financial assistance to fulfill the short-term objective. Thank you.